Welcome to this summary of one of the most fascinating success stories in stock market history. Today, we are exploring How I Made $2 Million in the Stock Market by Nicolas Darvas, a book that proves you don't need a finance degree or Wall Street connections to build extraordinary wealth. Picture this: a professional ballroom dancer, traveling the world with his partner, performing in nightclubs and theaters. He knew nothing about stocks, had never read a financial statement, and certainly never imagined he'd become one of the most talked-about traders of his era. Yet, Nicolas Darvas did exactly that, turning a small stake into over $2 million, using a system so simple yet so effective that it revolutionized how many people think about trading. What makes Darvas's story so compelling isn't just the money he made, it's how he made it. While most people were listening to hot tips and following the crowd, Darvas developed his own method through careful observation, relentless discipline, and what he called the box theory. This is not a story about luck or insider information. It's about a mindset that treats the stock market like a serious business, not a casino. By the end of this summary, you will understand exactly how Darvas built his fortune, and more importantly, how you can apply his principles to your own investment journey. So whether you are a complete beginner or someone looking to refine your approach, get ready to learn from a man who turned dancing into millions through the power of systematic thinking. Part 1. The Dancer Meets Wall Street. Nicolas Darvas was not your typical Wall Street success story. While other traders were glued to ticker tapes in Manhattan, Darvas was performing the tango in nightclubs across Europe and Asia. His introduction to the stock market came through pure chance. A nightclub owner paid him with shares instead of cash. At first, Darvas treated stocks like most beginners do. He listened to everyone: brokers, friends, taxi drivers, anyone with an opinion. He chased hot tips and acted on rumors. The result? Disaster after disaster. He had buy a stock because someone whispered it was going to the moon, only to watch his money disappear faster than applause after a bad performance. Imagine trying to learn dance by copying random moves you see on the street. That's exactly what Darvas was doing with stocks. He was following everyone else's choreography instead of developing his own. The losses piled up. Money that should have been building his future was vanishing into thin air. But here's what separated Darvas from the millions of other failed traders. Instead of quitting or blaming the market, he recognized a fundamental truth. He was not investing, he was gambling. This realization hit him like a spotlight on stage. He understood that successful trading required the same dedication he gave to dancing. You cannot become a professional dancer by guessing. You need technique, practice, and discipline. The same applied to the stock market. So Darvas made a decision that would change his life forever. He stopped listening to others and decided to develop his own system. He began treating the stock market not as a get-rich-quick scheme, but as a serious business that demanded respect, study, and systematic approach. The lesson here is crystal clear. Never rely on tips from others. The market does not care about your cousin's friend's guaranteed winner. Your success depends on developing your own understanding and your own system. Part 2. The Birth of a System. After his costly education in what not to do, Darvas began his transformation from amateur gambler to systematic trader. But remember, he was still traveling the world as a dancer, performing night after night in different cities. He could not spend his days in broker offices or pore over financial newspapers like traditional investors. This limitation became his strength. Forced to rely on telegrams and delayed information, Darvas learned to focus on what truly mattered, not the daily noise, but the underlying patterns. He started keeping meticulous records, treating each trade like a scientific experiment. Think of it like learning a new dance. At first, every step seems random and confusing, but as you practice and observe, patterns emerge. You notice that certain movements flow naturally into others. That rhythm has structure, that successful dancers share common techniques. Darvas began to see similar patterns in successful stocks. Before making big upward moves, winning stocks behaved in remarkably similar ways. They would trade within certain price ranges, building energy like a dancer preparing for a dramatic leap. Volume would increase, showing growing interest. Then, when the conditions were right, they would break out of their trading range and soar. He realized that the stock market, like dancing, was not random. It had rhythm and structure. Prices moved in patterns, and these patterns repeated themselves over and over again. But Darvas didn't just observe, he tested. Every hypothesis was put to the test with real money. When something worked, he refined it. When something failed, he learned from it and moved on. This wasn't guesswork, it was systematic development of expertise. Most importantly, he learned to trust price and volume over everything else. Not company news, not analyst recommendations, not economic forecasts, just pure market behavior. The market itself was telling him what it wanted to do next. The lesson: the market rewards pattern recognition and disciplined observation. Success comes not from predicting the future, but from recognizing repeating patterns in market behavior. Part 3. The Box Theory Explained. Now we come to the heart of Darvas's system, the famous box theory. Don't worry, this isn't complicated mathematics or complex formulas. It's beautifully simple, which is exactly why it worked. Imagine a stock's price movement as a ball bouncing in a box. The ball's stock price bounces up and down within the walls of the box support and resistance levels. Most of the time, the ball stays within these boundaries, but sometimes the ball gains enough momentum to break through the top of the box and reach a new level. Here's how Darvas defined a box. When a stock trades between a clear high price and a clear low price for a reasonable period, that's a box. For example, if a stock consistently trades between $20 and $25 for several weeks, that $20 to $25 range is the box. The magic happens when the stock breaks out of the box. When the price moves above $25 on strong volume, it's signaling that something has changed. New buyers are entering, demand is increasing, and the stock is ready to move to a higher level. But here's the crucial part. Darvas only bought when the breakout was confirmed. He didn't guess or hope. He waited for the stock to clearly break above the box with volume backing the move. This prevented him from buying false breakouts that would immediately fall back into the box. His rules were ironclad. Rule 1 only: buy on confirmed breakouts above the box with strong volume. This ensured he was buying strength, not weakness. Rule 2: place stop losses just below the box. If the breakout failed and the stock fell back into the box, he was out immediately with a small loss. Rule 3: let winners run. Never sell too soon. Once a stock proved itself by breaking out, he held on as long as the uptrend continued. Rule 4: avoid emotional decisions. The system made the decisions, not his feelings. Think of it like this. Imagine you are watching people trying to jump over a fence. Some try and fail, falling back down. But when someone not only clears the fence but does so with power and momentum, you know they are likely to keep running. That's exactly what Darvas looked for in stocks. The lesson: structure and rules protect your capital while maximizing your upside potential. Having a clear system removes emotion and guesswork from your trading decisions. Part 4. Discipline over emotion. While other traders were glued to their screens, sweating over every tick, Darvas developed something far more valuable: emotional detachment. This wasn't coldness or indifference, it was professional discipline. Remember, Darvas was still traveling as a dancer. He would place his trades via telegram and then go perform, often not knowing how his positions were doing until the next day. This forced distance became his secret weapon. Most traders destroy themselves by watching their stocks too closely. Every small move up fills them with greed. Maybe I should buy more. Every small move down triggers fear. Maybe I should sell now. They become emotional ping-pong balls, bouncing between hope and despair. Darvas avoided this trap entirely. He compared his approach to a chess master who follows strategy rather than reacting to every single move. The chess master has studied positions, understands patterns, and sticks to proven principles even when the game gets intense. His isolation from daily market chatter was intentional. He stopped reading financial newspapers, ignored broker recommendations, and avoided the opinions of other traders. Why? Because he realized that most market noise is just that, noise. It creates confusion and emotional reactions that lead to poor decisions. Instead, Darvas developed what we might call systematic confidence. His confidence didn't come from hoping he was right. It came from knowing his system had been tested and refined. When a trade went against him, he didn't take it personally or try to prove the market wrong. He simply followed his rules and moved on to the next opportunity. This emotional control extended to his wins as well. When a stock soared, he didn't celebrate too early or become overconfident. He knew that today's winner could become tomorrow's loser if he didn't maintain discipline. Think of a professional athlete in the zone. They're not thinking about the crowd, the pressure, or the consequences. They are executing their training, following their preparation, trusting their system. That's exactly the mental state Darvas cultivated. The lesson: emotional detachment leads to consistent decision-making. Your biggest enemy in the market isn't other traders or market conditions. It's your own emotions. Part 5. Darvas in action. Winners and losers. Theory is worthless without real-world results. So let's look at how Darvas applied his box theory in practice. His approach wasn't about being right all the time. It was about managing risk while maximizing the potential of his winners. Take his famous trade in Lorillard Tobacco. Darvas noticed the stock forming a box between $25 and $28. For weeks, it bounced within this range, building energy like a coiled spring. Then, on strong volume, it broke above $28. Following his system, Darvas bought immediately and placed his stop loss just below the box at around $24. What happened next was magic. The stock didn't just break out, it soared to over $50, giving Darvas nearly a 100% return. But here's the key. He didn't predict this massive move. He simply recognized the pattern and trusted his system to capture whatever move occurred. Another success was Zenith Radio. Same pattern, same approach. The stock formed a clear box, broke out on volume, and Darvas rode it for substantial gains. He wasn't trying to catch bottoms or time perfect entries. He waited for the market to show its hand, then followed the momentum. But Darvas was refreshingly honest about his failures too. Not every breakout worked. Sometimes stocks would break above their box only to fall back down, triggering his stop losses. The difference was that these losses were small and controlled, while his winners were allowed to run freely. This is crucial to understand. Darvas didn't win because he was right more often than wrong. He won because when he was right, he made much more money than he lost when he was wrong. His average winner might make him $100,000, while his average loser only cost him $200,000. He focused exclusively on growth stocks, companies with the potential for explosive movement. He wasn't interested in steady, dividend-paying stocks that moved slowly. He wanted stocks that could double or triple when they broke out of their boxes. Darvas also shared stories of trades that didn't work out as planned. Sometimes he'd exit too early, missing larger moves. Sometimes he'd hold too long, giving back profits. But he learned from each experience, constantly refining his approach. The lesson: success is not about being right all the time. It's about managing risk and maximizing gains. Small controlled losses combined with large unrestricted gains create wealth over time. Part 6. The importance of self-education. Behind Darvas's success was a relentless commitment to learning. Despite having no formal financial education, he became a student of the market in the truest sense. He read hundreds of books, studied market history, and built his own understanding of how markets behave. But here's what made his education different. He focused on price behavior and patterns, rather than traditional financial analysis. While others were memorizing balance sheets and income statements, Darvas was studying the psychology of market movement. He famously said, "I believe in analysis and not forecasting." This distinction is profound. Analysis means studying what has happened and what is happening right now. Forecasting means trying to predict the future. Darvas realized that the market's current behavior contained all the information he needed to make decisions. Think about it this way. When you are driving, you don't need to predict exactly what will happen. You need to react to what's happening right now: the car changing lanes, the red light ahead, the pedestrian crossing. Darvas applied the same principle to trading. His education was practical and focused. He didn't get lost in economic theories or complex financial models. Instead, he studied how successful stocks behaved before making big moves. He learned to read volume patterns, understand momentum, and recognize when institutional money was flowing into a stock. This self-directed learning gave him something invaluable: independence. He wasn't relying on someone else's analysis or recommendations. He had developed his own ability to read the market's signals. Darvas also understood that markets evolve, so his education never stopped. He continuously refined his methods based on new observations and changing market conditions. The lesson: study the market's behavior, not headlines or predictions. True market education comes from observing patterns and testing ideas, not from memorizing theories or following expert opinions. Part 7. Psychology of a winning trader. The most fascinating aspect of Darvas's success wasn't his system, it was his psychology. He understood that the biggest obstacle to trading success isn't market complexity or lack of information. It's the trader's own mind. Darvas identified the three emotions that destroy most traders: greed, fear, and hope. Let's see how he conquered each one. Greed typically makes traders hold winning positions too long, hoping for even bigger gains. They turn smart trades into disasters by getting greedy at the worst moment. Darvas fought this by having clear rules about when to sell and sticking to them religiously. Fear causes traders to exit good positions too early or avoid good opportunities altogether. The fear of loss becomes so strong that it prevents rational decision-making. Darvas conquered fear by accepting that losses were part of the business. His stop-loss system meant he knew exactly how much he could lose on any trade before he entered. Hope is perhaps the most dangerous emotion because it feels positive. Hope makes traders hold losing positions, thinking they will come back. Hope makes them ignore their stop-losses and turn small losses into disasters. Darvas eliminated hope by making his decisions mechanical. When a stock hit his stop-loss, he sold automatically, regardless of how he felt about it. But developing the right psychology wasn't just about controlling negative emotions. Darvas cultivated what we might call professional detachment. He treated each trade like a business transaction, not a personal bet. When a trade went against him, he didn't take it personally or try to get even with the market. Think of a surgeon performing an operation. They can't let emotions interfere with their technique. They follow their training, make precise decisions, and don't second-guess themselves in the middle of a procedure. That's exactly the mental state Darvas developed for trading. He also understood the importance of patience. Most people want immediate results from the stock market, but Darvas was willing to wait for the right opportunities. He had watched stocks for weeks or months, waiting for them to form proper boxes and break out with conviction. This patience extended to his profits as well. When he had a winner, he didn't rush to take profits. He let the market tell him when. The move was over, often holding positions for months as they continued to climb. The lesson: the biggest obstacle isn't the market. It's the trader's own psychology. Success comes from developing emotional discipline and treating as a systematic business rather than gambling. Part 8. Why most people fail in stocks. Through his journey and observations, Darvas identified the common mistakes that doom most stock market participants. Understanding these pitfalls is just as important as learning the right techniques. First mistake: overtrading. Most people cannot sit still. They feel they need to be constantly buying and selling to make money. Darvas realized that successful trading is mostly waiting. Waiting for the right setup. Waiting for confirmation. Waiting for profits to develop. He might watch dozens of stocks, but only trade a few that met his strict criteria. Second mistake: chasing tips. We have all heard them. My brother-in-law knows someone who says this stock is going to explode. Darvas learned early that tips are usually disasters waiting to happen. By the time information reaches the general public, smart money has already acted on it. Third mistake: lack of a plan. Most people buy stocks without any idea of when they will sell. They don't know what they will do if the stock goes up, down, or sideways. Darvas had a complete plan before entering any position: where he'd buy, where he had sell for a loss, and how he had managed profits. Fourth mistake: no control over emotions. We have discussed this extensively, but it bears repeating. Most traders let their emotions drive their decisions. They buy when they feel optimistic and sell when they feel scared, which is exactly backwards. Fifth mistake: following the crowd. When everyone is talking about a stock, when it's making headlines, when your hairdresser is giving you stock tips, that's usually the worst time to buy. Darvas made money by identifying opportunities before they became obvious to everyone else. Darvas understood a fundamental truth: the crowd is usually wrong. When everyone is buying, it's often time to sell. When everyone is panicking, opportunities are being created. His success came partly from doing the opposite of what most people naturally want to do. He also observed that most people treat the stock market like a lottery. They want to get rich quick with minimal effort. But Darvas approached it like building a business, with systematic methods, patience, and discipline. The lesson: the crowd is usually wrong. Discipline beats noise. Success comes from avoiding the common mistakes that trap most market participants. Part 9. Adaptability and long-term success. One of the most important aspects of Darvas' approach was his recognition that markets change, and successful traders must adapt. He didn't fall in love with his system or believe it would work forever unchanged. Darvas understood that different market conditions favored different approaches. During strong bull markets, his momentum-based box theory worked brilliantly, but he was wise enough to recognize when market conditions weren't suitable for his style. During periods when the market was choppy or declining, when stocks weren't making clear breakouts, Darvas would step aside. He didn't try to force his system to work in unsuitable conditions. This might seem obvious, but it's incredibly difficult for most traders to do. They feel compelled to always be in the market, always be making money. Think of it like shoring. A great surfer does not try to ride every wave. They wait for the right conditions, the right wave, and then they commit fully. When the waves aren't good, they wait on the shore. Darvas applied the same patience to trading. He also continuously refined his methods based on new observations. The box theory evolved over time as he learned more about volume patterns, breakout confirmation, and position management. He wasn't rigid in his approach. He was flexible within his disciplined framework, This adaptability extended to his profit-taking strategies. Initially, he might have sold too early, afraid to give back profits. Over time, he learned to let his winners run longer, understanding that the biggest gains come from patience. Darvas also adapted his position sizing as his account grew. With more capital, he could take larger positions while still maintaining proper risk management, but he never let success make him reckless. If anything, he became more disciplined as his wealth increased. Perhaps most importantly, he remained humble. He never believed he had conquered the market, or that his success was guaranteed to continue. This humility kept him sharp and prevented the overconfidence that destroys many successful traders. The lesson: flexibility and humility are key to lasting success. Markets change, and successful traders must be willing to adapt their methods while maintaining their core principles. Conclusion: as we conclude this remarkable journey through Nicolas Darvas's transformation from dancer to millionaire trader, let's crystallize the key principles that made his success possible. First, trade with structure. Darvas didn't guess or gamble. He developed a systematic approach and followed it religiously. His box theory provided clear rules for when to buy, when to sell, and how to manage risk. Second, focus on momentum and volume. Rather than trying to catch falling knives or predict reversals, Darvas bought strength and rode momentum. He let the market show him its direction rather than trying to impose his own opinions. Third, cut losses quickly. Ride winners. This simple concept is easy to understand, but difficult to implement. It requires conquering the natural human tendency to hold losers and sell winners too early. Fourth, ignore noise. Follow your system. In our age of constant information and social media chatter, this lesson is more relevant than ever. Darvas succeeded partly by isolating himself from the noise and trusting his own analysis. The beauty of Darvas's story is that his $2 million was not the result of luck, insider information, or market manipulation. It was the product of method and mindset qualities that anyone can develop with dedication and discipline. His success proves that you don't need a Harvard MBA or Wall Street connections to succeed in the market. You need patience, discipline, and the willingness to develop your own system rather than following the crowd. But perhaps the most important lesson from Darvas's journey is this: success in the market is not about prediction, it's about preparation. He did not try to forecast where stocks would go. Instead, he prepared himself to recognize opportunity when it appeared and to act decisively when conditions were right. As you apply these lessons to your own investment journey, remember that becoming a successful trader or investor is like learning any other skill. It takes time, practice, and patience. Darvas did not become successful overnight, and neither will you. But with the right approach and mindset, extraordinary results are possible. The market is still there, still creating opportunities, still rewarding those who approach it with discipline and respect. The question isn't whether opportunities exist, it's whether you are prepared to recognize and act on them when they appear. Take Darvas's lessons, adapt them to your own situation, and remember, the best time to start building your own systematic approach to the market is right now. Thank you for joining me. The explanation of how I made $2 million in the stock market by Nicolas Darvas. Remember, knowledge without action is worthless. Start applying these principles today, but always remember to invest responsibly and never risk more than you can afford to lose.